Welcome to the Torch Academy. In this episode, we're explaining the purchase agreement, what you're actually signing, and what it all means. The purchase agreement is the most important document in the entire transaction. The LOI is a roadmap, but the purchase agreement is the binding contract. Everything gets hammered out here. You're committing to sell, the buyer is committing to buy, and all the legal protection mechanisms are documented. This is not something you skim and sign. If you have an attorney, have them review every word with you. And if you don't, read it slowly yourself and flag anything you don't understand. These sections work together. The purchase price and allocation determine your taxable gain. Reps and warranties define what you're guaranteeing. Indemnification limits how much you're liable if something is false. Non-compete restricts what you can do after closing. Closing conditions are the escape hatches if something goes sideways. Understand each one. This section spells out exactly how much you get and when. The allocation of purchase price is critical for taxes. Goodwill is taxed as capital gains. Better for you. But if the buyer allocates too much to covenant not to compete, which is ordinary income, your tax bill is higher. If you work with a CPA, talk through realistic allocations with them before negotiations. By signing, you're swearing these things are true. If they're not, the buyer can come back and claim indemnification. Reps are usually broad but have exceptions. Example: all financial statements are accurate except as disclosed in Schedule B. So if you have a known issue, disclose it up front. That's not a breach of reps, that's transparency. The second half of the reps covers what you own and who's on your team. You're swearing the assets are clean, no hidden liens or disputed ownership. Payroll records match what you've reported, and there are no pending employee claims you haven't flagged. And any intellectual property is properly yours to transfer. If any of this is fuzzy, disclose it. Surprises after closing become indemnification claims. Indemnification is where risk stays with you post-closing. You want to negotiate hard on caps, baskets, and survival periods. A survival period of 24 months is standard. Less is better for you. A basket of $50,000 means small issues go away. A cap of 15% means your liability is limited. These terms matter for your post-sale risk. This example shows why good accounting matters. An honest mistake costs you money after closing, and why disclosure is important. If you disclosed the accounting method difference up front, it wouldn't be a breach of reps. Indemnification protects buyers from surprises. Minimize your exposure by being transparent. Non-competes are standard. Buyers want to make sure you're not selling them the business, and then starting a competitor down the street. Negotiate hard on the term, geography, and scope. 3 years is reasonable. 10 years is onerous. Tri-state area is reasonable. International is overreach. Negotiate this down to what makes sense for your situation. If you have an attorney, they'll push back on everything. That's their job. But you need to pick your battles. The price is most important. Payment terms are second. Indemnification terms are third. Non-compete scope is fourth. Don't die on every hill. Let the buyer win some rounds. The goal is a deal that closes, not a perfect contract. If you're working with an attorney, they'll flag traps. If not, here are the ones to watch for yourself. Common ones: reps with no basket or cap, unlimited liability, survival periods of 3+ years, non-competes that are unreasonably broad, or working capital adjustments that heavily favor the buyer. Market standards exist for a reason. If the buyer's agreement deviates wildly, that's a red flag. Closing conditions are how either party can walk away if circumstances change. If the buyer's bank doesn't approve the loan, that's a closing condition. The buyer can't close. If a major customer terminates the contract before closing, that's a material adverse change. Understand these conditions because they determine who has what leverage if something goes wrong before closing. The purchase agreement is coming. Prepare now. Know what you're willing to guarantee and what you're not. Know your red lines on non-compete, indemnification, and survival. When the agreement arrives, you and your attorney, if you're working with one, can move fast and negotiate effectively. Remember, the purchase agreement is the document that governs your entire relationship with the buyer after closing. Every clause matters, and the ones you don't understand are the ones that can hurt you. If you can work with a good M&A attorney, that's money well spent. Either way, read every page and don't let deal fatigue push you into signing something you haven't fully reviewed. Thanks for watching. If you found this helpful, head over to torchapp.io/signup and create your free account. Torch uses AI to help you navigate buying or selling a small business. Whether you're just exploring or ready to make a move, we can help. And don't forget to subscribe for more episodes from the Torch Academy.